no matter what you choose, there's really a 4-step process. And so what I'm going to do is each of these 4 steps, we're just going to take you through 2 or 3 of the areas that we think are important. So number 1, understand your limits. We've talked about budget. We've talked about knowing your credit score. Credit score is especially important in the housing side too, because that can determine whether you get the loan or not. Front and back end ratios, because we're members of the Church of Jesus Christ, do we have other expenses that other people don't have? Yeah, we pay tithes and offerings. Ideally, too, we should be paying ourselves, too. So does that impact what we should be using on our housing, too? And then you'll choose your preferred loan type, what you need for a down payment, some other things. Again, today's discussion, I encourage you to go through the skills development problems. It will take you through this presentation in greater detail. So let's talk a couple of things. Bank ratios. So what are bank ratios? It used to be, before we had credit scores, the way the banks would determine who got a loan was they would say, okay, how much money do you make? And they would calculate these bank ratios. They call them a front end and a back end bank ratio. So what they found out is that people, they should only use a certain percentage of their income, take home pay, to pay for mortgage expenses. And then they also had a certain percentage that paid for your mortgage plus your debt expenses. And then later on, people started looking at credit score. And people saying, well, wait a second, a credit score, high credit score means I should be able to get a mortgage loan. But then what they found out is some people with high credit scores, but because they didn't make enough money, they weren't making their payments. So it's interesting, it started here on the left side, then it moved over to credit score, and now it's back and moving in the middle. So now what they're doing is they're looking both at front and back end ratios plus credit scores as well. So we want to have a pity party. What does pity stand for? Principal, interest, taxes, and insurance. So what have we found out? What are acceptable front and back end affordability ratios?
You didn't really talk about, you're not looking at the pity thing.
Yeah. So what they do is they have what's called the front end ratio.
Okay.
So it's called your housing expense ratio. What they recommend is principal plus interest plus property taxes and insurance should equal less than 28% of your take-home pay. And then your back end ratio takes into account all of your debt obligations. So take your PITI and any other long-term debt, car payments, student loans, things like that. And that should equal less than 36%
of your total income.
Of your total income.
And also, remember that the banks, they want you to borrow as much money as possible. So sometimes they might approve you for more than you can really afford because they want you to buy a nicer house. So they get more money off the interest payments and stuff. So you should not buy at the top of whatever the bank's going to loan you. You should probably come in the middle or go lower at the lower end of what the bank's willing to loan you, because you don't want to strap yourself so much that your house is so expensive that you can't even afford to buy food.
So be aware. So you front end ratio, back end ratio, what will the bank do? Generally, the bank will lend you the lesser of those two ratios.
But don't borrow all that they're going to give you.
Yeah. And then the question, what's your preferred loan type and terms? So really, three main types of loans. Number one, a 30-year fixed. What happens here is the lender takes the interest rate risk. So they'll charge you a higher interest rate, but it's fixed for the life of the loan. Makes it a lot easier for budgeting other purposes. You could also do an adjustable rate mortgage. So if you've heard a thing called a 3-1 ARM or a 5-1 ARM, the first number is how long is it fixed for, and the second number is how often it adjusts. Mm-hmm. So an adjustable rate mortgage is a mortgage where interest rates adjust annually
according to what's going on.
According to market conditions. What do we recommend? We recommend a 30-year term
But
just
you were
because it's
preferred-
fixed.
You preferred on 15.
Yeah, well, if you can get 15.
If you could do 15, that's even better. But,
So
know
let's
that
take a look.
calculator.
The top one is loan type over the last 15 years. The orange is a 30-year fixed. The blue is a 15-year. Why would a lender be willing to offer a lower interest rate on a 15-year loan versus a 30-year loan? He gets his money back quicker, so it's less risk. Now, why would they be willing? This is a 5-1 arm, so it's fixed for the first 5 years, and then it changes every year afterward. Now realize your arm, for most of them, they can increase up to 2 percentage points per year and up to 6% over the life of the loan. So, and then the question is, let's talk about some of the costs you need for a home. First of all, your down payment is 3 to 20%. In the US, there's a thing called private mortgage insurance. If you have 20% less than 20% equity in your home, you have to have PMI. So in case you don't make the payments, it makes the lender whole. So you have to pay for that. It's generally $50 to $80 for every $100,000. So on a $300,000 home, it could be $200 or $300. But if you have 20% equity in the home, you don't have to pay that private mortgage insurance. So,
and the reason that you have private mortgage insurance is that the creditor wants to be assured that if you can't pay for the house, if you don't make the payments, then the insurance kicks in and makes that so they don't lose their money.
So the assumption is, since you have no equity in the home, what's going to keep you just from walking away?
Right.
But the assumption, if you have 20% equity in the home, there's much less chance you're going to walk away from it.
Right.
And then there are points. Points is, think of points as prepaid interest. And so what it is, it's used to basically buy down your interest rate. You actually don't want to pay points. If you, for example, sometimes if you pay 1 point, you can get an interest rate 0.25% lower. But realize the points stay with the lender. So if you agree to a $200,000 loan with 2 points, you have to pay back $200,000, but you only get $196,000. So realize that's the case. So you want to try to minimize points. And then other closing costs, title insurance, title fees, property insurance. Before we sold our house in Arlington, Virginia, we had to give a termite inspection. We had a lot of termite damage.
So we had to get it all fixed before we could sell it.
Right. So, and then there's a thing called escrow payments. Generally, you'll pay property, principal and interest, and then you'll pay a little bit more on top of that, and that goes into an account. And from that account, you pay your property insurance, your property taxes, and other things there too. So that's called your escrow accounts. So for a home, you're going to need anywhere from 5 to 25% of the home's
Purchase
price.
So it adds on to what you just borrowed.
Okay, do you want to take it? I need this.
Drink. He needs a drink. So there's a six-step process to finding your home. First of all, decide what's really important to you. Like when we first bought our first house, it was just important to get a house. We didn't care as much about anything because we just were trying to get into the market. Okay, then we wanted, then we actually, our second house, we wanted to get it on, we didn't want a fixer-upper, so we bought a house that was fairly new. And then that house was on a hill. So our kids were learning how to ride a bike, and we had to go down at the bottom of the street for them to ride their bike because we were on a hill. And if you kicked the ball would just roll down the hill.
Quarter of a mile until the ball would stop.
So then our next house, we decided we wanted to be on a cul-de-sac. So we bought a house on a cul-de-sac. Mm-hmm. But it didn't really have much of a view. So the next house, we decided we wanted to be on a cul-de-sac with a view. So that was our last house before the townhouse.
And now we just want a house that's comfortable.
That we can walk away from.
Permission.
So anyway, but you have to decide what's really important, develop a plan and build your team, like you have your mortgage broker and you have your realtor and different people. And then once you're serious about it, get a home inspection on a house that you are thinking about. When we were buying our house in Utah, when we were moving from California to Utah, it was a for sale by owner. So we didn't have to have an inspection, but we had a realtor helping us, but she didn't want to use realtors at all. But we were getting a home inspection on the home. And she's like, why are you getting a home inspection? Are you just trying to find something wrong with this house? And we're like, no. We want to know exactly what we're buying. So you have a home inspection so you know what the problems are, if there are any, and so you know exactly what you're getting into.
You don't want to buy someone else's problems.
Right, exactly. And then determine if there's fees. Like our last house and this house also has this.
Conditions, covenants, and
it's
restrictions.
A homeowners association, so we have to listen, do that. Then you negotiate the price. So, what are some tips about finding the right home? Decide what's a must-have and what's nice to have. And then list everything, and then engage in have a good realtor.
Realize that realtors are paid by the sellers. You don't pay the realtors.
Right.
They're paid by the sellers.
Right. So, and look around and make sure that you take the time to find exactly what you want. Don't just be in a rush to get something really fast. Just do your research and take your time when you're buying a house. Once you found the home you want, what should you do? Walk around the neighborhood, attend the ward,
We
visit
like
the
just
schools.
walking around and talking to people.
Yep, get a good appraisal, get a good home inspection. Don't be emotionally attached. The best thing you can do is walk away. Like, there was one house that we thought we really wanted, and we offered them a high price at the beginning, and then at the end we finally lowballed them. No, we lowballed them first, and then we offered the high price. It was almost up to their expectation, but then they were like, well, we'll take that price, but we want to live in it for 4 more months after we paid for it. We're like, no, sorry. So you have to be willing to walk away. We were willing to walk away from that house, and we found our next house just a couple doors down right after that. Understand the lending process. Choose multiple lenders, and so if you find you've got several lenders, go with the one that you like the best, but then take your best offer to them and say, hey, this is the rate that I'm going to get at this other lender. If you can beat it by
An eighth of a point.
certain amount, I'll go with you.
So realize that the lenders only get paid if you do the deal with them.
Right.
So this is the process. You find a home that suits your lifestyle using a realtor. Realtor refers you to a mortgage broker. You don't have to use the realtor's mortgage broker. We actually recommend you to use 2 or 3 of them.
The broker pulls your credit report, determines your needs, and tries to find the lenders among the competition to meet your needs, and you can use multiple brokers.
Realize with your credit score, you can have 3 people pull your credit on a 45-day window, and it's all counted as a single pull. So they assume that, oh, you're shopping for a mortgage, so they can have any number pull within a 45-day window.
Okay. And then each lender has unique programs. Just make sure you negotiate the points and the rates and the fees, and make sure that you're happy with it. Each broker recommends the best loan, and then you review everything, and then you make a final decision based on your broker's offers, the best one, the one that's the best for you.
So that's what Sister Sedgwick said. She said, you get your best offer among the 3, and then you take it to your favorite broker and say, if you can beat this, we'll go with you. And that way you can get the lowest rates.
Mm-hmm. Lender takes the loan package, structures the loan and conditions for any additional information that they need to close the deal. Then they also have to gather up the title, the escrow, the lender. They do all the work for the loan, and then the lender sends out the documents for signing, and then you
Guess
are
what?
a homeowner.
You're a homeowner and a dead owner too.
Yeah.
Loan owner.
Maintain your house well. Take care of it. Remember that 1 or 2% of the home's value actually you need to have for upkeep. And make sure that you have enough money extra after you're paying your mortgage that you can upkeep the house, and budget accordingly. And also, it's really important to have a professional cleaning done a few times a year so that you can maintain your home's value. And then also, now we're going to develop our plan. So if you plan how you will pursue the home decision, you'll make better choices. What's the maximum amount you will borrow? How soon will you have your house paid off? At what age do you want to have your house paid off? And then you're going to develop strategies with your plan on how to do the steps. Okay, so you'll have a vision. So these are ideas you can use in your plan, your PFP plan. The vision and goals. What's your goal? Is to have a modest model home that you can share with family and friends, a play area for the kids. We want to pay off our house.
I like garages.
Yeah, he did.
You play in
Our last house, our house
Had
had
too
6.5 garages. He's like, yeah, it had a lot of garages. It had 3 up and 2.5 down. 3 down, 3.5 down.
Yeah.
That's right. Anyway, but it was too much. But he liked it. He liked it a lot.
Okay.
So we strive to have saves 20%. This is your plans and strategies. 20% down for the house to get rid of the PMI insurance as quickly as you can.
So in Walnut Creek, we didn't put, I think we put like 10% down, but after a couple of years, we had paid down the mortgage and also the market had appreciated. So we knew we had over 20% equity, so we paid to have an appraiser come in and do an appraisal on the house.
And then you can get the private mortgage
And then
insurance
we sent that appraisal
removed
to the servicer, and it took off like $250 a month
off the private mortgage insurance.
because we didn't have to pay private mortgage insurance.
So, and then keep up your mortgage to the closest $100. Oh, you can up each mortgage payment to the closest $100 with a separate check. So you tell them you want to pay this on the principal, and then you can pay off your mortgage faster. Okay. Understand your limits.
Don't go beyond the limits.
Yeah. So understand those. Do your homework.
Do your footwork.
See what you must have. Don't buy the largest home in the neighborhood or with the highest priced home in the neighborhood because you might not get your money back when you sell it. Get a minimum of 3 mortgage brokers and make them bid against. So you got an extra S right there.
Oh, yeah.
Okay.
We have a formula called one of the tools, which is home loan comparison. It calculates your effective interest rate, but that's how you can tell you get the best deal. What is the rate that has the lowest effective interest rate?
Are you going to show them that later? No. Okay. And then also, if you're going to don't get a home loan with 2 incomes included. If you know you're going to go to 1 income in the future, base your home loan on 1 income. Buy a home that you can afford. Don't buy too much of a house, so you'll be so poor that you can't afford to buy the food.
Okay. Thanks, everyone.